looking at basically, we are looking at basically the last topic. Yeah, great. You're overcoming. And of course, we shall also be able to use this session to revise. So then the topic, of course, is the concept of what here? Budgetary controls. Budgetary controls. So whenever we talk about budgetary controls, what comes to our mind? First of all, ladies and gentlemen, all of us appreciate from our management accounting that a budget is a financial plan. It's a financial plan for a defined period. Could it be like a financial plan for Kenya government, how government will raise revenues, how government will spend its revenues for the next coming year. So once you've been able to come up with this budget, then it will be very important for you to always compare the budgetary figures with the actuals. So I'd budgeted to raise this much from people in terms of taxes, 1 trillion in a year, but you've raised in this case here, for example, 800 billion. So why the difference? When you're trying to answer this question, why the difference? Putting people into their respective areas of responsibility and accountability, we are doing what we call budgetary controls. Because by calculating variances, we call those differences variances. By calculating them, then we shall be able to, if it's a negative variance, what we shall be calling adverse variance, we shall be able to put into place corrective mechanisms, corrective actions. So we call those systems budgetary controls. So budgetary control is the process of comparing actual performance with budgeted performance, analyzing variances, and taking corrective action. It serves as both a planning tool and a control tool, ensuring efficient resource allocation and achievement of organization's objectives. Ladies and gentlemen, I've seen this severally. Your examiner asking you for the advantages of budgetary control systems. Advantages of budgetary control systems. Anytime you hear about your examiner asking you for the benefits, advantages, etc. of these budgets, always remember the advantages of management, the functions of management. Henry Fayol gave us 5 key functions of management, which are normally described using the POC, POCC. Yeah, that we use in this case. Your other management will be useful in planning, organizing, controlling, communications, coordination. So budgets, basically, these are the tools that the management will be using in most cases to execute these 5 functions. So the advantages of budgets will be the functions of management, that we use budgets to plan. We use budgets to organize our activities around our departments, and the personnel. We use budgets for purposes of controlling, ladies and gentlemen. Remember, at the very beginning of this year, all of us, including everybody, Milton, Wanjiko, Mildred, everybody here, we had resolutions. Have we been able to meet, ladies and gentlemen, our resolutions, which we had set at the beginning of the year? Let me get feedback from you, because when you put in resolutions, that is kind of a budget. It's a plan of action. Is there anybody who has been able to meet a good percentage of them? Then that's very good, Regina. Great. Some of them, and of course there are others that are what here elusive, isn't it? Yeah. Why are they elusive? It's simply because, we never put into consideration, all our actions, all our plans inside some guardrails. So we need these guardrails like that. So that anytime we want to falter and fall, at least we have something we can fall back on. And then, of course, we stand and continue with our journey. So assuming in this particular respective class, there is one person, for example, who had said, who does this bad thing, smoking. Yeah, he had said that, this year, I will never pull up a cigar. Nothing like that. So January went by. Very nice person. No cigarettes, actually, no even alcohol. February as well, a good month. Come March, this guy said, I'm doing so well. So if I'm doing so well, then what should I do? If I'm doing so well, what I should do, let me just try this bad activity just one time. It's a Friday evening. I have a friend here, just one more time. And then now I will stop in this case here, like now for the whole of for the rest of the year. All right. You see now in this case here, you have something that is trying to get you out of the major road. There's a devil in this case here who is beckoning your way, telling you, hey, misbehave a little bit, and then you'll be able to get back and continue with this great journey. Trust you me, if you tried that just one cigar, up to now, you've been smoking, you failed like that. And that is why whenever we put in a budget, we must also put in safeguard measures. These safeguard measures are the control mechanisms. So that anytime in this case you want to fall, then there is something in this case that tells you that, hey, you need to look at the bigger picture. We control our operations of the entity to ensure that we are able to meet the long-term goals. So you're saying that budgets will be useful for planning, organizing, controlling, even communications, ladies and gentlemen. These are the very best tools of communicating to all the stakeholders. Look at, for example, what happens whenever we have the Kenyan budget being read to us, in this case here by what year? By the minister. So you get to know a lot. That's communication. You are talking to the stakeholders. If you are an accountant here who does a budget and you don't present that budget to the various stakeholders, then automatically, in this case here, you are doing the wrong thing, because budgets, just like good managers, they have to speak to us. We use them for purpose of communication. This department, you as salespeople, our sales targets this time around is this. What is it that you need for you to be able to deliver these targets? So we need this and this. We put them on a budget communication. The same case with coordinations. We'll be able to know how these various departments here speak to each other. Yeah, in this particular year, these people will be idle in this department. Let's put them in this. So anytime, ladies and gentlemen, you're asked about functions, benefits of budgets, remember those 5. And then, of course, you can also add on the concept of budgets also being useful in terms of giving authority and, of course, defining delegation. It is through budget that you're able to tell, for example, in government, who is the AIE, who has the authority to incur expenditure. Yeah, and that name has to be given to the control of budget. Yeah, we also use these budgets, ladies and gentlemen, for purposes of performance appraisal, performance measurement. It is in this budget that we should be able to even define the key KPIs, key performance indicators. Yeah, we also use these budgets to motivate staff, for staff motivation. Employees who are able to hit favorable variances every now and then, let's give them some good perquisites. Let's pay them handsomely. So please don't let me down when they ask you that simple question as a theory question, having like 5 or 6 marks. Applications of budgetary control systems. We have what we call top-down budgeting. So budgets are set by senior management with minimal lower level input. Fast and strategically aligned, but may lack operational realism. So remember, ladies and gentlemen, that top-down basically means what here? That the senior management, the cabinet and our president up there, they put down all the budget for us. They scribble everything for us. And then, of course, down here, we'll be told implement as it is. That is top-down. It's an autocratic style of budgeting. Autocracy means what? Dictatorial. Yeah, we make the budget and then push it into your throats for you to implement. Yeah, of course, you'll be able to finish your budgeting process very, very fast. But at the end of the day, you have not involved the workers. So the workers will not be able to put in their very best into execution of this budget. We call it top down. And then now we have this democratic system of coming up with a budget. What in this case here we are calling bottom up budget, where now lower level managers prepare budgets which are consolidated upward. It improves accuracy because those people you think are so junior, trust you, may have always known this, that even my juniors at RCM, my juniors in my audit firm, Aura and companies and gentlemen, in this case here, some of them are really talented. They know quite a lot. When you involve them, your budget will be very, very accurate. And even it is going to have very innovative ideas. And these employees will feel so much motivated. Yeah, but can cause, in this case here, budgetary slack. Can cause what we call budgetary slack. What's a budgetary slack? Remember, a slack basically means over and above. Yeah, so slack means what here that there is a portion of this budget which will be unutilized. Why? When you involve these, ladies and gentlemen, employees, they know that you're going to measure their performance against their budget. So what they would want to do, if, for example, they know that they are going to use, say, 500 bags of cement, to make themselves look nicer, they're going to pad. It's called a padded budget. So they inflate the budget. So they put there, we are going to use 600 bags of cement. So that when it comes now to real construction, actualizing this budget, instead of them using 600, they use like 300 only. So when they use 300, they will be clapping for them for having saved the company. But you see, it is because of the padding. It's because of this budgetary slack. Slack means excess, which is not very good. Whenever you have excesses, it means that your performance appraisal will not be very, very good. Then we have what we call rolling budgets. What are rolling budgets? These are those budgets that we keep on updating continuously. Yeah, maintaining a constant 12-month horizon. It reflects current conditions, but adds administrative work. Ladies and gentlemen, please listen and listen to me very well regarding this rolling budget. I've seen this being applied, especially by these Swedish organizations. They're very accurate. They're always 12 months ahead. So what they do, for example, they prepare a budget for next year, 2026. So that is well. So come 2026, they start planning the budget. They start working with this budget. So January 2026 is over. When January 2026 is over, they remove this period that has been completed, but add now next year's January in their budgetary controls. So they bring now 2027 January, so that every time they are rolling, when February is over, they add the other February. So in this case, the budget is continuously moving. It's a rolling budget. January this year is over, then incorporate next year's January. February this year is over, then incorporate next year's February, and they keep on rolling and rolling and rolling like that. So this budget has got an advantage over accuracy, but the biggest disadvantage is the manpower. You need lots of people to be able to do a well done rolling budget. Yeah, and that manpower is not there. All right. Ladies and gentlemen, apart from that, we have in this case here what we call a zero-based budget. A zero-based budget, in this case, ladies and gentlemen, it is where you develop your budget from scratch. You develop your budget from scratch. Zero base. It doesn't matter how many years you have been in existence as an organization. So if we say we are doing a 2026 budget on zero-based basis, we shall be able to get fresh quotations from our suppliers. Everything we assume like we are starting this organization from scratch. And then we do a brand new budget. In Kenya, there is a time they started mentioning that they would want to use this zero-based. I mean, they could not, because you need lots of resources. Because every revenue, every expenditure line under ZBB, we call it ZBB, must be justified. Must be justified. Yeah, for you to say, for example, that I would want you to put this money in this budgetary line, you must tell us what is the cost of this activity and what is the benefit. We must do that justification. So it's a very, very complicated exercise. But most of these biggest companies, like in America, in the UK, most of them, they use what we call ZBB. Because ZBB will make managers and all employees to understand their organizations very well. It's quite saddening that most of us, ladies and gentlemen, outside here, we are running businesses purely through sheer luck. We are running businesses that we don't understand. Basically, we don't understand them. All right. If you want to understand your business very well and have every employee being very innovative, try this ZBB, zero-based. Let everybody justify their budgetary line items. If we think that the cost is outweighing the benefit, it's a loss-making activity, we say, so be it. We don't want it. So by doing that, you will end up being like these big firms like Nike. If you look at the shoes Nike used to produce the other like 5 years ago, I mean, they're very different from the kind of shoes they're producing today. Look at Toyota Japan. Most of those old vehicles used to have real metal. If you knocked, in this case here, a vehicle on the road with those old vehicles, which used to be very, very nice, somebody would have thought that they have been knocked, in this case here, by what here? By a tractor on the road because of how hard those vehicles were. But because of this business process re-engineering, because of this zero-based budgeting model here, where these farms keep on asking themselves, these metals we are using, they're pretty expensive. And yet, in this case here, the consumers, given the economic tough times, the consumers are becoming keen in terms of cost. So then what do? Let's keep on, in this case here, producing the do kind of vehicles, small vehicles, and use, in this case here, like plastics, kind of not packaging, but I mean plastic kind of water material. Yeah, so that in this case here, for example, if you go with this vehicle and just scratch, yeah, another vehicle that is ahead of you a little bit, what happens if this has ever happened to you? You can even get out of that car crying, thinking that you have been fully crushed. It's not your mistake. I mean, it's the kind of water material that is being used here. And those guys are able to innovate like that because of this kind of systems here. They are making use of zero-based budgeting. They're making use of, like, for example, the JIT, the just-in-time inventory systems. All right. So this is really, really very good. Like these lazy countries like Kenya and most of our lazy companies, ladies and gentlemen, we use what we call incremental budgeting system. Is there somebody who knows what an incremental budgetary system is? Incremental budgetary system. Like Kenya, in most cases, they only look at last year's budget. And then they do what here? They increase it by a constant percentage in every budgetary item. So they look at last year's budget and multiply, for example, everything with 1.1. 1.1. That's an incremental budget. You're simply increasing last year's. So the base becomes last year's budget. When it is zero-based budgeting, you don't have any base. You're building everything up from scratch. Can you confirm, ladies and gentlemen, that up to now we are together? Are we together, ladies and gentlemen, before I start using my board, before I start doing past paper question? Deng is saying we are together. Great. Thank you so much. And I'm so happy I can see we are 70 during the day. Is there anybody who is stealing their employer's time? I mean, I should not shout, but is there anybody who is stealing the employer's time? Anybody who is stealing the employer's time? I'm not shouting. I know you guys are hardworking, isn't it? I know you guys are hardworking and you'll be able to give them. All right, okay. Then I will not shout. Let's just continue. After all, whatever you're doing, yeah, I'm not shouting here. Whatever you're doing here, we'll be able to help them. Okay, we'll be able to help them. Thank you so much. Okay. Sorry for that. We shall overcome. We shall overcome. Now, ladies and gentlemen, then we have what we are calling activity-based budgeting. This focuses on budgeting based on cost drivers of activities. It really also improves cost accuracy, but requires detailed data. Incremental budgeting builds on previous year's budget with just small adjustments. Yeah. small adjustments. You'll hear MPs making a lot of noise, but there is nothing they're doing there. They're basically increasing things without even looking at whether those budgetary items were padded last year. All right. Yeah, it is simple, but may always perpetuate inefficiency, because inefficient budgetary activities which were given lots of money last year, because you're inflating them by 10%, then still we shall be able to have those activities getting more money, and yet they were inefficient. There is no justification for us to give money to this line item this year. All right. Yeah. So then at this juncture, I would want us to do a past paper question. No, before our past paper question, let me tell you what we shall do. Yeah, this is how I would want to start tackling these questions. And I'll be able to send this handout. Of course, I'd sent it, but there is just one item that I would want to add there. Yeah. One item I would want to add there. On what we call a flexible budget. Great, Rose, great. You're overcoming. So a flexible budget, I'll be able to add this and then resend. Yeah, it's not there in your syllabus if you look at it, but your examiner keeps on bringing it. Yeah, but fortunately, most of you did this in your management accounting, which you saw passed very well. So a flexible budget is a comprehensive budgeting system that is designed to show different cost levels for various levels of activity. So to flex a budget is to change a budget to reflect the real output. For you, you will not be required to go through all these characteristics and uses. For you, what you are required to do in a flexed budget is to prepare, ladies and gentlemen, a flexed budget, and then you give us what we call variances. And I have an illustration. I'll be able to call it, in this particular context, I'll be able to call it illustration number one. Illustration number one. So here, they have given us, ladies and gentlemen, a fixed budget for the year. So they've given us sales. We have DM, we have DL for direct labor, variable overheads, we have fixed overheads. Then they have given us actual results, where in this case here, we did produce 12,000 units. Remember ourselves, we had anticipated to just produce 10,000, but now actually we have produced 12,000 units. Yeah, so we are required in this case, ladies and gentlemen, from these two tables, number one, to provide a flexible budget. Let's provide a flexible budget. Let's give a flexible budget. Let's give a flexible budget. Let's provide a flexible budget. We are now giving a flexible budget. Let me just pull my computer closer. We shall overcome. Yeah, that's much better. You may not see my head, but it's not the head that is teaching. Most important here now is for you to see what I'm writing, ladies and gentlemen. So the first thing that you should do whenever you are doing, now we are writing a flexible budget. Now we are writing. So whenever you're talking about a flexible budget, the first thing you need to do is to give us what we call a flexing ratio. You must give us what we call a flexing ratio. You must give us what we call a flexing ratio. Give us a flexing ratio. How do we get this flexing ratio? To get flexing ratio, we normally take actual output divided by budgeted output. Actual output, divide this by budgeted output. Actual output, divide this by budgeted output. Yeah. So anytime you hear of you being required to produce a flexible budget First here, you have to give us a flexing ratio. And to get this flexing ratio, you take the actual output, you divide it by the budgeted output. Is there somebody who is able to give me the actual output from the two tables I've given you? Anybody who is able to give me the actual output, my good students? Somebody can take a screenshot of this and share them in the group so that I stop sharing that. So the actual output is 1,200. 12,000 actually. 12,000 actually. Divide this by, in this case here, the budgeted output, which was 10,000. So is there then somebody who can give me this flexing ratio? Remember, the budgeted output was given somewhere here. Budgeted output. Yeah, fixed budget. You can see the output or the number of units here that were sold. Yeah. So then by doing that, you guys are able to give me a number, isn't it? You guys are able to give me a number. Please give me a number if you don't mind. So somebody's giving me 1.2. Now, the moment, ladies and gentlemen, you are able to give me this flexing ratio, then I will be able to give you everything very nicely. This is now what I will do. I will come and first of all, do my budgets. I will first of all do my budgets. I will first of all do my budgets. So this I've been able to get. This I have been able to get. Great. So then I will be able to come here and do my original budget here. Original budget. Original budget. I go this way. Yeah, original budget. Original budget, yes. So this original budget, I can see here, they have given me the sales. Oh, yes. They gave me sales of 10,000 units times whatever. I don't even have to write this because this one I'm simply copying everything. This one I'm simply copying everything. So sales, they gave me a figure of sales. They gave me a figure of sales. Yeah, from the fixed budget. They told me sales is 100,000. Let's copy the way it is. We are copying this the way it is. Then we have expenses, of which the very first expenditure is direct materials, DM. And I can see DM, my good students, we have a figure of 50,000. 50,000. Then I have DL. DL, what am I able to see there for DL? 25,000. 25,000. Then I have VO. VO for variable overheads. I'm able to see there 12,500. 12,500. After VO, I can see fixed overheads. Fixed overheads, what am I able to see there? Fixed overheads, I'm able to see 10,000. So fixed overheads, I'm able to see 10,000 like that. Ladies and gentlemen, after you guys are able to finish writing up to here, could you kindly give me a thumbs up? Please give me a thumbs up. Once you write up to there, please give me a thumbs up. Thank you so much. So now come and write here a flexed budget. A flexed budget. So to flex is to change. And we only get to change those things, ladies and gentlemen, that are dynamic. Those things that change as output changes. Those are the only ones we shall change. The ones change as output changes. So as output changes, ladies and gentlemen, what do we have here? We know that sales is dynamic. Yeah, when we sell more. So this one, if it's dynamic, you shall multiply with 1.2. What do you think of direct materials? Are these kind of expenses dynamic or rigid? Are they dynamic or fixed? Are they dynamic or fixed? These kind of expenses. Yeah, they're dynamic. They keep on changing. Any direct expenditure, like materials, you know, if you're making chairs, the more the chairs we make, the more the material cost. So if it is dynamic, then I will be able to multiply this with the flexing ratio. The same is applicable to this. The same is applicable to this. But if this expenditure is fixed, if it's fixed, it is always at 100%. That one, you can never flex it. That one, you can never flex it. So then take these numbers, multiply them with this, give me the flexed budget numbers. So fixed overhead, that is always at 100% at 1, that shall never be flexed. So is there somebody who can easily give me these figures? Anybody who can easily give me these figures, ladies and gentlemen? Anybody who can easily give me these figures, I'll be very happy. Thank you, Marcy. 120,000. Because they have taken 1.2 times 100,000. 1.2 times 50,000, that gives me what here? 60,000. 60,000. And then we have in this case here 1.2 times 25,000. That gives me 30,000. That gives me 30,000. And then we have in this case here 1.2 times whatever, 15,000. So we have here 15,000. After that, fixed overheads, of course, this shall never flex. This shall remain the same. That shall remain the same. That shall remain the same. That shall remain the same. After that, ladies and gentlemen, come and give us the last column here for the actual results or actual profit and loss. The actual profit and loss. So the actual profit and loss, you don't labor doing it. The actual profit and loss, you will simply read. You will simply read. You will simply read. You will simply read the actual results that we have here. Read and write. So you can see the actual results. The actual results. What do we have here with sales? I can see the figure is 122,000. Actual. Actual. I'm simply putting it as is. These are the actual results. 122,000. Direct materials, we have 60,000. Then we have direct labor 28,500. 28,500. Then, ladies and gentlemen, after that we have 15,000, 11,000, 15,000, and 11,000. 11,000. Yeah, and then you can see the net actual profit given there is 7,500. Actual profit. Rather the profit, call it net profit. So the only net profit that I would expect you to give me is the net profit of flexed budget. So please don't put these figures in brackets, the expense in brackets here, no, because of flexibility. Don't put that. But of course, you guys are very bright. You know at the end of the day that to get net profit, you are taking this sales income, sales revenue, minus this, minus this, minus this, minus this. Then you give me an answer. Anybody who is able to give me that answer? So flexed budget, it shall be this, minus this, minus this, minus this, minus this expenditure. Anybody who is able to give me this net profit, my good students? Anybody who is able to give me this net profit, my very good students? You guys are very, very good. You guys are very, very good. Which reminds me that I owe you some money. I owe some of you, not all of you. I owe you some money. I'll think about it. Don't remind me, but I'll think about it. So come here, ladies and gentlemen, and give us a column of variances, because that the examiner will always ask you variances. The examiner will always ask you. So variances, we take the flexible budget versus actual budget. Whenever I'm getting variances, it is like this does not exist, but don't cancel it. Whenever I'm getting variances for control, we must always, ladies and gentlemen, compare the flexed budget and the actual results. So here, I had planned to raise 120,000 as my sales revenue, but I raised 122,000. Is there a variance? Is there a difference? Is there a difference? Yes, over how much? A difference of 2,000. Is this good for business or bad for business? Is it adverse or favorable? Is this adverse or favorable? Is this adverse or favorable? It is favorable because we ended up, ladies and gentlemen, making more sales. Our actual sales were higher. So this is favorable. And then 60 minus 60, this gives me 0. 0, of course, somebody may argue it's favorable, but the truth is, ladies and gentlemen, 0 is a neutral number. It's a neutral number. Just write it 0 like that. Then we have 30,000 minus 28,500. How much do I have? 30,000 minus 28,500. How much do we have? 1,500. But I'm so sure somebody is fearing to say whether it's favorable or adverse. adverse or favorable, adverse or favorable. To me, this is an expenditure. It's like how I can go to a supermarket expecting to pay 30,000 because my budget is an expectation, but I end up paying less. I will really walk out of that supermarket smiling because I've saved. So to me, it's favorable. Are you guys able to agree with me that it's favorable? Are you able to agree with me that it's favorable? Yeah, it's favorable. Then this is 0. And then the last one is 1,000. And because this is an expenditure, I can see an actual overrun. An expenditure, whenever the actual is more than the budget, then that is really, really bad, adverse. Please write A in full is adverse. Adverse is the same as what here? Unfavorable. Adverse is the same as unfavorable. Thank you, Koros. Then go ahead and add for us all these variances. Please go ahead and add for us these variances. So remember, when I'm adding, favorable is positive, adverse is negative. So we have 2,000 plus 1,500 minus 1,000. What figure are we able to get? Somebody is telling me 2,500. And if it's positive, then it should be what here? It should be favorable. If it is positive, then it should be favorable. And if you look at this versus this versus this, you can see we had budgeted to get a profit of 5,000. We had budgeted to get a profit of 5,000, but we actually got more. We actually got more. So 5,000 minus 7,500, that is 2,500, and it's a windfall. So it's a favorable variance. Then first one should be adverse, not favorable. Thank you, Rose. But you see, Rose, the first one is sales revenue. It's not an expense. This sales revenue. So for the first one, we had planned to get money, like your salary. You can imagine. Yeah, you had planned, expected to get a salary of 122,000. But your employer, in this case here, Rose, gives you 122,000. Won't you feel happy, Rose? When an income increases, Rose, you can imagine. You expected to get 120 in the bank. And then in this case here, your employer just pumps in 122. It tells you that there is a meeting you attended. You're supposed to get, yeah. So, you need to know how to interpret expenses and how to interpret revenues. Actually, that reminds me that I should be able to teach you another method. Another method which will be able to, yeah. So whenever, ladies and gentlemen, in this case here, we are calculating variances of incomes. Incomes you're looking at, for example, profits, sales, dividends received, etc. Yeah. So in this case here, how do? You take what we call AB, actual minus budget. Actual minus budget. And if positive, it shall be what here? Favorable. AB. So this is B, and this is A. So whenever you're getting variances of incomes, like profit, sales, always use the concept of AB. Yeah, so like now this is a sales, it's an income. Yeah, so it's AB. So 122,000 minus 120,000. So I'm able to get my variance. So in this case here, my variance here will be 2,000 because it's actual minus budget. And this 2,000 is positive. And because it's positive, I will not even reason. I will simply say it is favorable. The same case with this profit is an income. So I will say AB 7,500 minus 5,000, it is 2,500. Then automatically, because it's positive, it becomes favorable. It becomes favorable without thinking. At times, ladies and gentlemen, even myself, at times I fear thinking. Thinking is not easy. If I can get a model which will not use lots of my brains, the better. The better. Because thinking, especially when you're doing an exam, can really make you sweat a little bit. Yeah. So then, how about variances for expenses? So for variances for expenses, yeah, we always do now the opposite, BA. And if positive, favorable. If negative, adverse. So like the first expenditure is direct material, BA, 60,000 minus 60,000, neutral. 30,000 minus 28,500, 1,500 positive. And because I'm using this approach, because it's positive, I will note it as favorable. As favorable. 15 BA. 15 minus 15 is 0. 10,000 minus 11,000, it will be 1,000 negative. And I can't write negative. Instead of negative, I coin it by what here? Adverse. And then I'll be able to come and check whether if I take this minus this, I will end up getting that. I hope now, ladies and gentlemen, that concept is well sunk. It is well understood. Don't let me down in terms of this, should they bring a question of this nature in your exam. Then now please get out your past papers. Get out your past papers. We get to do a question. Get out your past papers. We get to do a question. Get out your past papers. We get to do a question. And now this one will be on activity-based costing. Activity-based costing. So this one will be on activity-based costing. Activity-based costing. Activity-based costing or activity-based budgeting. Very easy, 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 easy. Activity-based ABB. Where in this case here, we shall be able to apportion costs to the various activities that we have in an organization. So 𝐂𝐨𝐿, December 2023, question number 3B. December 2023, December 2023, question number 3B. December 2023, question number 3B. What I'm wondering, now that we have so many students of evening attending this one, when I will be teaching these things in your classes, what shall you be doing at that time? When I'll be teaching, repeating this in your classes, what shall you be doing at that time? Or will we cross the bridge when we reach there? We can cross the bridge. Or internalizing, okay. Or helping me teach here, great, okay. Or we do other questions, no? Great, all right. Thank you so much. So have you gotten this question? Have you gotten this question? Oh, you said bye-bye to them, okay. Have you gotten this question? Yeah, revision is the best. Revision is the best. Have we gotten this question, 𝐂𝐨𝐿? Thank you so much. So 𝐂𝐨𝐿 is a small manufacturing enterprise that makes only 3 products, X, Y, and Z. We are told the data for the month ended 30th November 2023 is as follows. So we have units produced and sold there. Sales price per unit, direct material cost per unit, direct labor cost per unit, product overhead cost total, and then we have the cost drivers. Information on the cost drivers is as follows. You can see direct labor hours, you can see machine hours per unit, you can see number of components per unit, number of component receipts, number of customer orders, number of production runs. Using ABB, compute the cost and the gross profit per unit for each product during this month. I'm telling you, if I'm the one doing this kind of an exam, yeah, like this December 2025, if they give you this kind of a question in an exam, you can even stand up a little bit and dance. These are your gods that are really, yeah, working in your favor. They are angels. Yeah, because you automatically, you'll be able to get 20 marks plus the theory here and there. You've passed this paper. You've passed this paper. You've passed this paper. This is really the easiest thing. As I always keep on telling you, there are those things, if we do them here, after you ask as many questions as you may wish to ask, and then you don't understand, then perhaps you weren't meant to become an accountant, even if you're at this level. There are questions, if they bring in your exams and you're not able to pass, then chances are you're being called elsewhere. You're being called elsewhere. Let's see. So the first thing that we shall do is to give our examiner what we call the overhead analysis schedule. Yeah. So what is an overhead? An overhead like this, top of the head. These are common expenses that must be apportioned. Common expenses metering, we shall be very nice because you just want to issue success. You shall pass. These are common expenses that at the end of the day must be apportioned. So then, ladies and gentlemen, we have in this case here our overhead cost. You can see overhead cost there. Yeah, overhead cost. We have a table for overheads there. So we have machining. We have production scheduling. Then, ladies and gentlemen, we have setup costs. Then we have here setup costs. Very easy. Then we have quality control. Very easy. Quality control. Then, ladies and gentlemen, we have receiving materials. Receiving materials. Then we have packaging materials. We have packaging materials. Then you can see the total cost. Total cost of machining is 102,000. We have 84,000. We have, ladies and gentlemen, 54,000. 49,200. We have 64,800. Then lastly, we have 36,000. So then they have given us what we call cost drivers. You can write them there, no problem. Cost drivers. So you can see the cost driver. The first one is machine hours. Number of production runs. Number of production runs. Yeah. Then we have number of component receipts. Then we have number of customer orders. I must have lost something. Production runs are supposed to be 3. They're supposed to be 3. Number of production runs. Number of production runs. Then we have number of component receipts. Number of component receipts. After number of component receipts, we have number of customer orders. Number of customer orders, like that. So we're going to use these cost drivers to apportion these total costs to our products, because now these are costs which are common to our 3 products, which are X, Y, Z. X, Y, Z, like that. Yeah, the question is December 2023, question number 3B. So please let me know once you guys are able to draw this table. I'll be very happy once you finish drawing this table. Once you finish drawing this table, I will be very happy. Thank you so much. And then now, ladies and gentlemen, once you've been able to do that, let's now pull through and get these numbers. So now we shall appraise each cost driver at a time. Cost driver analysis. Cost driver analysis. Cost driver analysis. We start with machine hours. Machine hours. For X, Y, and Z. Machine hours for X, Y, and Z. So for machine hours, I can see they have given me machine hours per unit. They have given me machine hours per unit. So whenever they give me machine hours per unit, remember ourselves, we always want total. We always want total. So whenever you see them giving you machine hours per unit, always multiply them with the number of units produced. Number of units produced. You can see down there information on the cost drivers. I'm able to see machine hours per unit. X, I can see 0.5. So I'll take 0.5 times the quantity of X given at the very top, units produced and sold. So X will be 0.5 times 12,000. And then I can see Y, which is 1 times 16,000. And then I can see Z, which is Z, it will be 1.5 times 8,000. So is there somebody who is able to give me this machine hours total? In ABB, we normally work with total metrics. Total metrics. So we have in this case here, Rina, giving me the first one as, nope. So I want the first answer. Machine hours, how much do we have there? 6,000. Then for Y, it will be 16,000 because it's 1 times this, 16,000. Then for Z, 12,000. Z, I'm being given 12,000. 12,000. Yeah. Then could you kindly give me the total? Give me the total. Total, I'm being given 34,000. So the proportion of this, if you are writing, the proportion of this, ladies and gentlemen, it will be 6,000 over 34,000 over the total, 34,000. Meaning that these zeros, I can kill them, right? Without breaking anybody's bone, I can kill them. So then you look for any cost which is being divided by the machine hours, like this one or 2,000. So for X, what am I going to absorb in X? So in X, I will take the proportion of X times 1 or 2,000. You give me a number, I write. Because now these are the proportions, absorption rates. So you take 6 over 34 times 1 or 2,000. You give me a number, I write there. Because now we know the proportion of X, eh? Yeah, we're using machine hours to apportion this. So X is 6 over 34 times 1 or 2,000. Anybody who is able to give me this answer, please? Because now we have the proportions now. Wait, they're not talking to me now. They're not talking to me. They're not understanding. They're not understanding. They're not understanding. Oh, 18,000? 18,000. So X in this case here will be 18,000. How about Y? Do I know the proportion of this particular overhead? Y will consume. Yes, I know Y will consume 16 over 34. So 16 over 34 of the total cost. 16 over 34 of the total cost, which somebody is giving me a figure of 48,000. 48,000. And then we have, in this case, the last one is 12 over 34. Yeah, times 1 or 2,000. Anybody who is able to give me that figure, ladies and gentlemen, I'm being given a figure of 36,000. 36,000. And that is it. 36,000, and that is it. Do we have any other cost that is using machine hours? No, no, no. So I'm through with this cost driver. So this is cost driver number 1. You look for another cost driver. Look for another cost driver. The next cost driver is number of production runs. Number of production runs. So here we have number of production runs. So number of production runs, I have to be very, very, very keen. So I'll be able to look for this number of production runs, which I can see down there before required, that last line on the table. Number of production runs, I can see 6, 16, and 8. 6, 16, and 8. Let me ask you a question. Am I going to multiply these numbers with the production quantities of X, Y, and Z? Am I going to multiply those numbers? Like 6 times the production quantity of X is 12,000. Am I going to multiply them? No. Why? Because they never said number of production runs per unit. You see, machine hours, we have to do that because they mentioned machine hours per unit. We only get to involve number of units whenever they are mentioned here. That was machine hours per unit. This number of production runs are a total for the entire. So this one, you simply come and add everything and they give me the total. Add everything and give me the total 6 plus 16 plus 8, which will end up giving me what figure? 6 plus 16 plus 8. This will end up giving me what figure? 30. 30. So in terms of proportions, this will be 6 over 30. This will be 16 over 30. This will be 8 over 30. And now you know what you're supposed to do. We see the second on production schedule. This 84,000 has to be apportioned using this number of runs proportions. So if it is X, it shall be 6 over 30 times 84,000. Times 84,000. So Mildred is giving me 16,800. Mildred is giving me 16,800. So if it is Y, it will be 16 over 30 times production schedule cost of 84,000. 44,800. So this is 44,800. Yeah, and then we have the last one, which is 8 over 30 times 84,000, which will end up giving me 22,400. 22,400. Thank you so much. 22,400. Thank you so much. And you can see I'm lucky because this number of production runs again is what I will be using to apportion the setup cost of 54,000. Because they're sharing, they have this number of production runs in common. So again, I will take 54,000 times the proportion of X. You give me an answer there. You give me an answer there. I want to write it. I want you to give me an answer there. I want to write it. So somebody's giving me 10,800. Now we can move with speed. So this is 10,800. Thank you so much. 10,800. Thank you so much. Thank you so much. So then we have the second one. It will be 16 over 30 times 84,000, which will give me 28,800. 28,800. Thank you so much. Then the last one will be 8 over 30 times 54,000, which will end up giving me what figure? 14,400. 14,400. Thank you so much. Thank you so much. Now from there, third one, we are so lucky because the third item, actually the fourth item, is using number of production runs. So the same production runs proportions are the ones we shall use. So then we have, ladies and gentlemen, yeah, what do we have here? The next one will be 49,200 times 6 over 30. Now you guys give me the answers I write. I simply want to write them. 9840. So this is 9840. Yeah. The next one will be what here? Somebody? 26,240. 26,240. 26,240. Thank you. And then the very last one. 13,120. Thank you so much. Then we have in this case here, the next one now depends on number of component receipts. Now I can comfortably rub this one. I can comfortably rub this one and write here number of component receipts. So number of component receipts. So number of component receipts, have they given this to me directly? Yeah, I can see number of component receipts. Yeah, don't be deceived by number of components per unit. We have number of component receipts, and you can see we want number of component receipts, and they're given in totality. They're given in totality. So number of component receipts, I can see 1880, 64. 1880 versus 64. So are you able to add 4, ladies and gentlemen, and give me an answer there? 18 plus 80 plus 64. Yeah, I'm being given a figure of what here? 162. 162. So then I know the proportions. So this will be over 162, over 162, over 162. No. That's enough. So for X, ladies and gentlemen, given this 64, 800, X I know is 18 over 162. I write those three answers there. Now I can write, for example, I can see Rina Monica giving me 7,200. 7,200, 7,200, 7,200. Thank you, Kakaman. And then we have Y. So Y, what do we have there? 32,000, 32,000. So remember, if you are here and you would want to join our block revision, our number is 0793 555 000. That's our number. 0793 555 000, like that. Yeah. The last one, ladies and gentlemen, I'm being given a figure of 25,600. 25,600. 25,600. Ladies and gentlemen, we have packaging cost. Packaging cost, we have the issue of number of customer orders. Number of customer orders. So packaging cost, we have a number of customer orders. Number of customer orders. So number of customer orders, I pray that this has been given to us directly. Yes, I can see 620 and 10. I can see 620 and 10. So divide by. So this will be 36, over 36, over 36, over 36, like that. Over 36. So is there somebody who is able to give me these values now very fast, now that you guys have become experts? 6,000. My board is not very well aligned. 6,000. Yeah. So 20 over 36 times 36,000. 20,000. Thank you so much. 20,000. And then we have the last one, which will end up giving us what figure? 10,000. The last one I'm being told is 10,000, right? 10,000. Thank you so much. So please go ahead and give us the total overheads. Go ahead and give us the total overheads. Go ahead and give us the total overheads. Give us the total overheads. Give us the total here. Total overheads. For X, you add. Y, you add. Z, we add. You're almost finishing. We're almost finishing. The moment we finish this question, that will be it for today. That will be it for today. So for X, so you add up everything. So we have 18 plus 16, 800 plus 10, 800 plus 98, 40 plus 7,200. Mildred gives me 68, 640. Yeah. And then Y, ladies and gentlemen, please do something there for Y. So you're adding the column of Y. Uh-huh. 199, 740, 199, 840, 199, 840, 199, 840. Thank you so much. 199,840. Thank you so much. Then now we have the one for Z. We have the one for Z. So for Z, what do we have here for Z? Somebody? 121,520. 121,520, like that. So after you get this, remember you have not done full costing. To do full costing, you must come and add prime costs. You add prime costs, primary costs, the direct costs. So prime cost, I can see two of them. So we have here direct materials. Direct materials. So direct material cost, ladies and gentlemen, I can see up there on the first table, this has been given on a per unit basis. This has been given on a per unit basis. So direct material cost per unit, 16. So then I will take 16 because it's given for each unit times the number of units of X, which are 12,000. So 16 times 12,000. Yeah, and then we have for Y is 24 times 16,000. 24 times 16,000. And then lastly for Z, direct material cost per unit, 20 times 8,000. 20 times 8,000. So then are you able to give us these answers, ladies and gentlemen? Direct materials, the first one I'm being told is 192,000. So this is 192,000. Yeah, 192,000. How about for Y, the second one? 384,000. So this is 384,000. From there we have, ladies and gentlemen, the last one, which will be 160,000. 160,000. We also indeed do have what they are calling direct what here? Direct labor cost. Direct labor cost. So we have here direct labor cost. Direct labor cost. So now the labor cost, I'm just rubbing in my board because it's quite small. So we have here our labor cost. So our labor cost, I can see also labor cost has been given us 8 per unit. So we have 8 for X times 12,000 units we produce. Then we have in this case here direct labor for Y is 12 times 16,000. 12 times 16,000. Then, ladies and gentlemen, the last one, we have 8 times 8,000. 8 times 8,000, like that. So then what do we have at the end of the day? What do we have at the end of the day? So is it only machine hours that we multiply by number of units? Harvey, it's not about just machine hours being multiplied by number of units. You must understand the concept. Can somebody in this case here tell us, for Harvey to understand better, can somebody tell us why did we multiply machine hours by output? Why did we multiply machine hours by output for Harvey to understand this? Because I don't want you to cram like it. So anytime I see machine hours, I have to multiply. No, there is logic behind that. There's logic behind that. Let me see whether there is anybody who is able to see that logic. Yeah, the machine hours are given on a per unit basis. The others, there is none here that is given on a per unit basis. The others are given as total. Yeah, also, for example, if it was direct labor hours, if we had one for direct labor hours, then I would have multiplied with number of units because direct labor hours also have been given on a per unit basis. Thank you so much. So then go ahead and give us these numbers. Already we have them. No. So the first one is 96,000. Is there somebody who is able to give me the second one? 12 times 16,000. 192,000, right? So 192,000. And then the last one for Z, what do we have there? 64,000. Now we have exhausted all costs. So now you come and add and they give us total cost, both primary and overheads. Total costs, both primary and secondary. So you take these three, you add these three, you add those three. Total cost. You add those three. Because of my space, I will be forced in this case here to rub this. So we have here X, Y, Z. So we have total cost. So total cost for X, somebody has a figure, 356, 640. Somebody already has a figure for X, total cost. So now I'm waiting to hear from you for the other. So 77, 58, 40, 77, 58, 40. Then we go to Z. So for Z, what do we have here for Z? 345, 345, 520, 345, 520. Thank you so much. And then you can see they want us to give them cost per unit. Therefore, cost per unit, like for X, I'll take this 356, 640, I divide by 12,000 units. For Y, I will take this 77, 58, 40. I know the Y units, I know the Y units are 16,000. For Z, ladies and gentlemen, I will take 345, 520. I divide this by the output of Z, which is 8,000, like that. So please give us these figures. Give us these figures, cost per unit. Y is supposed to be 77, 58, 40. 77, 58, 40. Yeah, that's what I have for Y. That's what I have for Y. That's what I have for Y. So is there somebody who is able to give us these answers pretty fast? The first one is 29.72, 29.72. Yeah. Then the second one, ladies and gentlemen, 48.49, 48.49, and then the last one, which is Z, the last one, which is Z, be 43.19. Thank you so much, Fatima. 43.19, like that. So double underline, because that is one of the components that these examiners had asked us to get. If you look at the question wanted us to use ABB to compute the cost and the gross profit per unit for each product. So now we do the gross profit. With your permission, I'll be able to do the gross profit. And it's not gross profit for the entire output, no, just gross profit per unit. So are we able to see the selling prices, ladies and gentlemen, on table number 1? The selling prices they're given there 50, 70, 60. 50, 70, 60. So we come here and less the cost per unit, which already we happen to be having here. 29.72, 48.49, and then 43.19, like that. Subtract. So now we have profit per unit, gross profit per unit. So then X will be equal to who? 10.28. 10.28, and then Y, what do we have here for Y? It's 20, not 10, 20. 20.28. And then Y at the end of the day, 211, So Y is 211. Oh, no, 21 point something, 21.51. And then lastly, we have 16 point something. 16.81. 16.81. 16.81. Thank you so much. And ladies and gentlemen, I hope your children, the ones who are in JSS, yeah, grade 8 and whatever, and then the Form 3s and Form 4s, I hope your children are doing tuitions, online tuitions with us. I hope your children, if you have got a bigger kid, I hope they're doing tuitions with us. Like today, I'll be able to have a math session with them and of course mentor them like that. Otherwise, it has been great hosting you here. Thank you so much. See you later. Bye.